Good morning, it's Tess, and this is Stay Curious with Tess. And today I wanted to talk about what is wealth. And for those that don't know, I am a 35-year statutory accountant from the insurance industry. And a few years back, I changed into becoming a life agent, and I help families build their financial futures using the infinite banking concept. And I've been doing work with annuities in the past 6 months as well. So I'm looking at life differently, and I'm sharing financial terms and financial strategies that have things that I've learned over my career and things that have been recent additions to that repertoire of education. So today I wanted to talk about wealth, and I wanted to talk about wealth because depending on who you are, it can have different meanings to it. And sometimes we use words interchangeably and they have different meanings. So what I wanted to talk about is, can someone earn a high income and still not be wealthy? What do you think? And I believe the answer is yes, because income and wealth are not the same thing. So for those that have been around, I get on this so that we can talk about defining things so that we understand them, because we can decide and make better decisions once we have an understanding. Better definitions lead to better financial decisions. And today, let's talk about wealth. People often use words like income and wealth as if they mean the same thing, but they don't. Income is money coming incoming, so income is coming in, but wealth is what you've built and what supports your future. Wealth is having assets that produce cash flow and give you control over time and financial decisions. So there's a difference. And I think that's a really good way to look at it. Income is incoming. Wealth is what you're building. It's your fortress. It's your foundation. It's the thing that will carry you into the future. It's not an income. It's a product. It's an item that you've built. I want to kind of talk about different things. Cash flow is king. We've talked about cash flow in the past. Cash flow is important because I've, in my career, run across a lot of people that have a ton of real estate and no cash flow. I've had those moments myself since I've left the W-2 world, because I was used to a consistent, steady income every couple of weeks, but that doesn't work the same way when you become an entrepreneur and it's based on commission. You don't have the same income coming in. So there's a lot of different terminologies that can kind of affect how people look at wealth. So cash flow is king. Wealth isn't just what you own, it's whether your assets produce income. The control part matters. If someone else controls your money, say Wall Street, your 401k company, you have less financial freedom, so you aren't in control. Someone else is in control. Your assets need to work for you. I know I mentioned that before. That kind of goes back to the rich dad, poor dad days. If money's in your pocket, while liabilities are taking money out, you're going to want to take a look at the incoming versus the outgoing and make sure that your future is kind of stable. Financial freedom comes from passive or recurring income. You know, it's kind of funny that I spent 35 years in the insurance industry, and while I saw a lot of passive income inside the four walls of the insurance company, I for many years didn't think it applied to me. I didn't know how as an individual person I could bring passive income into my life, and I think that's probably been one of the greatest gifts in the past 6 years, is learning how infinite banking works and how to kind of run my money through as a bank inside the infinite banking process, which is the process is foundationally supported by a whole life policy, specially designed so that it has a high early cash value. But I had to learn that all the tools that business people or the ultra rich use are tools available to all of us if we're willing to dig in and get some education. So wealth is owning assets that generate cash flow, preserve control, and create financial freedom. And now that we've talked about wealth, some people could very well earn a very high income and spend almost all of it. So that maybe, in my eyes, isn't wealthy, because you're still living paycheck to paycheck, just like the person who's making a very small income. They often talk about how as your income goes up, you got to control that your expenses don't inflate just as much as your income inflated. Another person may earn less. So we just talked about someone with a high income could spend every penny that they have coming in. Is that wealthy? In my opinion, no, it's not wealthy, because all the same worries apply to you as somebody who is living paycheck to paycheck because they have a very, very small income. But another person may earn substantially less and save consistently, reduce their debt, cut expenses where they can, build assets, increase their net worth over time, have cash flowing in so that they can manage their life. And that to me is more of a wealthy person, a person who has a solid foundation. They have a fortress. They have an ability to handle any kind of the fluctuations that happen in life. So who is wealthier? That person that has a huge income and blows every penny of it, or that person who makes substantially less but has plans into play? They're saving, they're reducing debt, they're building assets. Which one is wealthier? Income just tells us how much money's coming in, but wealth reflects what remains and what we've built over time. So for me, the wealth is the person with the foundation. They've got the castle that they've been building on, adding a new turret and building on it and making it bigger, more foundationally. It will go into future generations. That to me is wealth. I think knowledge is a form of wealth. I think there are material things, and there are like the psychological or the educational things that will also increase the wealth. So thinking about everything we've discussed over the past 11 talks, this is my 12th talk, I want you to think about different parts of coming together for wealth, because these are all things that come together as part of your portfolio or part of your castle or part of your foundation, part of your structure. And those things are assets. Assets are those homes, those cars, those coins, those investments. They're the solid things that are expected to give you a value in the future. Liabilities can be things that you owe for that asset you purchased, so it may reduce the amount of asset you have, or it may be liabilities for credit cards for everyday expenses that you purchased. But liabilities are reducing, in my opinion, your wealth, because they're reducing your foundation, so to speak. Cash flow is that thing that if you don't have cash flow, you know about it and it hurts, because you want to be able to drive up to the gas station and get a tank of gas if you need it. Because I know there's credit cards, but even that sometimes can get bottlenecked if somebody has spent up to the limit. They might be looking card to card to see where they can move forward. So you want to know that there is incoming and that you can utilize it at the time that you want it. You want to make sure that wealth is in having enough assets, liquid assets, so that at a point in time, if an opportunity presents itself, you can act upon it. Liquidity, I just kind of mentioned liquidity. Cash flow is kind of hand in hand with liquidity. Liquidity means that, is your 401k liquid? Unless you're over 59 and a half, probably not, because there would be penalties and interest if you needed to tap into it. And in some 401ks that you're actively an employee of an organization, there are certain rules, like first-time homeowner, hardship loans. There's reasons that you have to produce in order to get a hold of any of that money. But there will generally be a penalty for getting a hold of it. So is it liquid? Probably not. If you have a bank account or you have a cash value in your whole life policy, those are more liquid, that you can get them within a short span of time. Net worth is back to that idea that if you have assets and you subtract off your liabilities, net worth is what is left and what remains. What's interesting about net worth is that's something that we always looked at in the insurance industry, because our insurance regulators control the growth of insurance companies based on net worth. I'm not sure if you guys are aware of this, but I'll just share a little insurance tidbit from my previous life, or my current life actually. Net worth is what an insurance company can write in premium in the current year. There are like rules that if an insurance company has, let's just say $100 net worth, and we know their numbers are way bigger than that. But depending on what state, because insurance companies are regulated at the state level, they can write $1 to $3 of premium for every dollar they have in surplus, or their net worth. So when an insurance company wants to grow, their growth is controlled by the amount of assets they have that are not spoken for. And by that I mean assets minus any liabilities gives you that net amount, and that controls the growth of an insurance company. So you don't have to worry about them growing too fast and not being able to manage their book of business because there's a regulator, somebody somewhere watching over what they do. Another thing we talked about is financial independence. What does that mean to you? Have you defined it? Do you know what will give you comfort? And if you don't, maybe you need to look at that. Opportunity costs. Anytime we're purchasing something, we should be looking at what are the opportunity costs. If I go out and I buy that car tomorrow, is it going to stop me from buying the house I want in a month or 2 months? If I'm trying to get a mortgage, if I go out and buy a car, is it going to stop me from getting that mortgage I want? There's a lot of things to think about with opportunity costs. And opportunity costs can sometimes be in the whole life arena, in building the infinite banking concept. What we love is that if you put it into your whole life policy first, you can have an opportunity to use that money twice, which is a great tool for controlling opportunity costs, because it's hard if you work for these assets and in one quick sweep they're gone again. So wealth isn't just one of those things that I mentioned, and I'll go through the list again kind of quick. Wealth isn't just one of these things. It's kind of all of them. Wealth is your assets, your liabilities, your cash flow, your liquidity, your net worth, your financial independence, opportunity costs. Wealth isn't just one of those things. It's influenced by all of those things. So that's why building wealth is generally a process. It's not a single decision. It's a process. It's a book. It's a plan that you've put together. And it's the result of many decisions made consistently over time. So instead of asking, how much money do I make? Try asking, am I building something that will benefit me in the future? Because if you're only looking at how much I make and how fast it goes out, you're just kind of existing. You don't have a plan. But if you're building wealth, are you building something that will benefit you in the future? And I think that's a different question. And I think that's a better question. So I wanted to kind of sum this up with a thought to remember. Remember this. Income helps pay for today, but wealth helps to prepare you for tomorrow. Because wealth is often built quietly through consistent decisions over time. And I'll say that one more time. Income helps pay for today. Wealth helps prepare for tomorrow. Wealth is often built quietly through consistent decisions over time. Remember, we get together every day so we can define, understand, and decide so that we can make better financial decisions. And until next time, stay curious, keep learning, and take ownership of your financial education. And I look forward to chatting with you tomorrow.